All right. So, we're always looking ahead, right? Trying to figure out what's coming next.
Always.
And, with 2025 right around the corner, there's definitely some,
Yeah.
some rumblings about what the economic picture might look like.
For sure.
And, how that could affect, your money, your investments,
Absolutely.
that kind of thing. And, we're hearing a lot about a potential recession,
Yeah.
stagflation, which is, always a fun word.
Not a great combination, no.
And then, those trade tensions that seem to, never quite go away.
Right. Always simmering in the background, it seems.
So in this deep dive, we're really going to try to cut through all that noise, all those headlines, and really focus on, some practical steps, some things that you can actually do.
Right. Actionable advice.
Yeah, exactly. To kind of navigate these potential headwinds that might be coming our way. And, we've got a great resource for this deep dive.
Yeah, I think it's going to be really useful.
This financial article that really caught our eye.
Yeah, it's titled, interesting, it's titled in French as texte collé,
Oh, wow.
which essentially translates to pasted text. But I think for our purposes, you could think of it as a really insightful analysis on what could be considered some of the safer investment options as we head into 2025. And it's a timely topic given, everyone's talking about it.
Yeah, everyone's, understandably a little anxious about what the future holds.
For sure.
And, so our mission here really is to take this article and kind of, distill it down to the core insights, the actionable advice, the stuff that you can actually use so that you feel, more informed and less kind of overwhelmed by, whatever market ups and downs might be on the horizon.
Exactly. Yeah, and I think that's what everyone wants, right? To go beyond just the headlines and really understand what's driving these recommendations and why they might make sense.
Absolutely. And, the article kind of jumps right into it. They don't shy away from this whole cloud of economic uncertainty that's kind of, hanging over us. And I'm curious, what are the main sources of anxiety that it points to right off the bat?
Right out of the gate, it really flags, recessionary risks, the potential for stagflation, which, as we mentioned, is that really tricky combination of slow growth and then inflation on top of it. That's, not a good recipe.
Yeah, that's a double whammy.
And then, of course, ongoing trade tensions. These are kind of the big three concerns that the article highlights as, creating this environment of unease for a lot of investors.
And it's not just, kind of theoretical. It calls out some actual market movements that, we've already seen this year.
Yeah, exactly. To kind of bring it home and say, look, this isn't just, abstract worry. This is actually happening.
Real world stuff.
Yeah. So, for example, it mentions that the S&P 500, experienced a 10% drop earlier this year. And then a stock like Tesla, which, a lot of people follow, saw an even sharper decline, something like 30%.
Oh, wow. Yeah, that'll get your attention.
Yeah. So these are, the not abstract worries. We're seeing volatility in action, and I think that's contributing to a lot of the anxiety.
Yeah, for sure. And, the article also talks about how political uncertainty, specifically this whole threat of increased U.S. tariffs, how that plays into the picture. I'm curious, why is that tariff issue so important in all of this?
Well, the main worry with increased tariffs is that they can really act as, an inflationary pressure. So if the cost of imported goods goes up because of these tariffs, businesses are going to face higher costs. And then, they're likely to pass those increases on to us consumers in the form of higher prices for everything.
Yeah, everything gets more expensive.
Right. And that's where this stagflation concern becomes really relevant, because if the economy is already slowing down and then prices start going up, it can really, dampen consumer spending and business investment and create kind of a vicious cycle that's hard to break out of.
Yeah, it's like a ripple effect. Uncertainty kind of shakes the markets, and then you layer on top of that, the potential for prices to keep going up. And
Yeah.
you can see why people might be a little apprehensive about their investments.
Yeah, that's natural.
In this kind of climate, for sure. And that's actually where the article makes a really, interesting shift. I think it starts talking about the danger of reacting emotionally to this uncertainty, the danger of panic.
Exactly. And, the article really underscores how this ambiguity, this uncertainty that we're talking about can actually lead to, investment decisions that are driven by emotion and fear.
Yeah.
And that often doesn't work out well in the long run.
Yeah, your emotions can kind of hijack your thinking.
Right. It gives a really stark example of this. This is really powerful.
Yeah.
It talks about an investor back in 2020, the beginning of the pandemic, and, the market downturn there. And this investor, gripped by fear, decided to sell their entire stock portfolio right at the lowest point.
Oh, no.
Yeah. And then they bought back in later after the market had already recovered significantly.
So they missed out on the rebound.
They completely missed the rebound and essentially locked in their losses. And that's a really tough lesson to learn. And it highlights how reacting emotionally to these temporary market drops can be far more damaging than, writing it out.
Then weathering the storm.
Exactly. Because, you might make a decision that feels good in the moment, but in the long term, it can really hurt you financially.
Yeah, it's like that old saying, buy high, sell low. That's the opposite of what you want to do.
That's the recipe for disaster.
And the article also, calls out the role of financial news in all of this and how it can sometimes, maybe not intentionally, but amplify these anxieties.
Yeah, it's interesting because, the financial media, they thrive on dramatic headlines and, big market swings. Those are the stories that get the most attention. And, while it's important to stay informed, being constantly bombarded with negative news can really exacerbate those feelings of unease and make people more prone to making those impulsive decisions that we were just talking about.
Yeah, it's hard to, keep a level head when you're seeing, red arrows everywhere and the headlines, screaming about, the sky is falling.
Right. And I think that's why it's so important to remember what the article emphasizes, that markets are cyclical. These periods of correction, these drops of, 5%, 10%, even 15%, they're normal.
They happen.
They're an expected part of investing. It's not, a sign that everything is going to collapse.
Right. It's not necessarily a catastrophe. It's just, part of the cycle.
Exactly. And I think that's a really important perspective to keep in mind.
For sure. So, that kind of leads us to the big question. How do we actually navigate these uncertain times, in a way that protects our investments without giving in to that panic, that fear?
Right. And the article lays out some really helpful, I think, fundamental principles.
Like a framework.
Exactly. A framework for how to approach this. So the first, and I think most important, is building and maintaining a strong emergency fund.
Yeah.
This is like your financial safety net. Make sure that you're not forced to sell investments at a bad time if you have an unexpected expense.
Right. You've got that cushion.
Exactly. And then the second principle is diversification. The idea of not putting all your eggs in one basket, spreading your investments across different asset classes, sectors, geographies, all that good stuff.
To spread the risk.
Exactly, to help reduce your overall portfolio risk. And then the third key strategy, which the article really digs into, is investing in defensive stocks. And these are companies that tend to hold up relatively well during economic downturns.
Okay, let's talk about those defensive stocks because that's what the article, really gets into the nitty-gritty of. And it gives us 7 specific stocks that it considers to be, in the safer category. But before we get into the names themselves, can you just kind of explain what makes a stock defensive in the first place? What are we looking for here?
Sure. So in general, defensive stocks are companies that provide essential goods or services, things that people need and continue to buy no matter what's happening in the economy. Think food, household staples, healthcare.
The essentials.
The essential, exactly. And these businesses tend to have more predictable earnings, and their stock prices don't fluctuate as wildly as, companies that are more tied to the economic cycle.
So they're a little bit more stable.
Exactly. A little bit more steady, a little bit more predictable.
Which is, kind of what you want when things are uncertain. So let's walk through these 7 stocks one by one, kind of get a sense of, why they're on this list. The first one is Berkshire Hathaway, trading under BRKA and BRKB. Why does the article highlight this one as a defensive play?
So Berkshire Hathaway, famously led by Warren Buffett, is included primarily because of its, incredible diversification and its history of being very resilient over, many economic cycles. It's basically a giant holding company that owns pieces of tons of different businesses, Apple, Coca-Cola, American Express, all these big names, and they're spread across so many industries that, if one sector is struggling, another one might be doing well, and that provides a lot of protection during uncertain times.
Right. So it's kind of like, not having all your eggs in one basket, but having 1,000 baskets.
Yeah, exactly. And, Buffett is known for his, long-term approach and his ability to allocate capital effectively. So, it's a company that's not going to be, making knee-jerk reactions to every market movement.
Okay, that makes sense. What about Johnson & Johnson, J&J? What's the thinking there?
So Johnson & Johnson is a big player in pharmaceuticals, medical devices, consumer health products, and all that kind of stuff. And the article emphasizes that their business model is just fundamentally very robust. Healthcare is always in demand. People are always going to need medicine and medical care. regardless of, what the economy's doing. And that consistent demand means they have very reliable and stable earnings.
So it's kind of like a recession-proof industry in a way.
To a certain extent, yeah. People will always need to take care of their health.
Okay, number 3 on the list, Procter& Gamble PG. Everyone knows their brands. What makes them a good defensive pick?
So Procter& Gamble, they focus on those everyday consumer staples.
Yeah.
Think laundry detergent, shampoo, diapers, toothpaste, things that people buy no matter what. Even if they have to cut back in other areas, they're still buying these things.
Right, those are essentials.
Exactly.
Hmm.
And that consistent demand allows them to generate very steady and reliable revenue. And that tends to make their stock a lot more stable, especially during times of economic uncertainty.
So they're kind of like, the bedrock of the consumer market.
In a way, yeah.
Yeah.
They provide those essential products that people rely on day in and day out.
All right, number 4, Costco, Costco. This one's interesting. A membership-based warehouse retailer. What's the defensive angle there?
So the article highlights the stability of the warehouse store model, especially during economic uncertainty. Because when people are looking for value, they're looking to stretch their dollars, Costco, with their membership fees and their bulk purchasing and their, low prices on a wide range of goods. It really resonates with consumers.
Yeah, it's all about value.
Yeah, and that focus on value tends to lead to pretty consistent sales volume, even when the economy is struggling.
So it's almost like, a counter-cyclical play in a way.
In a sense, yeah, when times are tough, people might actually shop at Costco even more.
Okay. All right, number 5, Coca-Cola. KO, a classic name. Everyone knows it. What makes this a safe stock?
So Coca-Cola, the article actually calls it an indétrônable classique,
Wow. I don't even know what that means.
which basically means, an unshakable classic. It's just this iconic brand with huge global presence, and it generates tons of recurring revenue. People are always buying Coke, and that makes it a very reliable investment choice, especially when markets might be volatile.
Yeah, it's like a comfort food almost. People turn to it when times are tough.
In a way, yeah, it's a familiar and reliable brand,
Yeah.
and that can be very comforting during uncertainty.
Okay. All right. Number 6, McDonald's, MCD, fast food resilient, even in a downturn.
Yeah, it might seem counterintuitive,
Yeah.
but the article suggests that fast food chains like McDonald's tend to do pretty well even during economic challenges.
Really?
Yeah, they're adaptable, they're everywhere, and they offer, affordable options for eating out, which can be really appealing to people who are trying to watch their spending.
So it's like a trade down almost, Instead of going to a fancy restaurant, you go to McDonald's.
Right. It's a more affordable option, and it's familiar, and, it's comforting.
Yeah, it's consistent.
Exactly.
And then finally, number 7, PepsiCo PPP. What's the argument for this one?
So PepsiCo is similar to Procter& Gamble in that they have this really broad portfolio of products, not just Pepsi, but all kinds of snacks and food items. And that diversification gives them a very stable income base. Because even if people cut back on some things, they're still buying, their essential food and beverage items.
Yeah, it's like, they've got their fingers in a lot of different pies.
Exactly. They're not reliant on any one product or category.
Which makes them more resilient.
Exactly.
Okay, so looking across all 7 of these, the common thread seems to be companies that provide goods or services that people just keep buying no matter what's going on in the economy.
Exactly. It's all about that consistent demand and that reliable revenue.
And the article wraps up by really emphasizing, something we talked about earlier, this whole idea of adopting a long-term perspective.
Right, and I think this is really key.
Yeah.
Market fluctuations are just part of the game.
Yeah.
They're going to happen. Ups and downs are inevitable. But the key is to have a plan and to stick to it. Don't get caught up in the short-term noise, the daily headlines, all that stuff.
Don't panic.
Exactly. Don't panic. If you have a well-thought-out strategy and you're invested in good quality companies, just stay the course.
Write it out.
Yeah, write it out. And, the article actually goes even further. It suggests that you can view volatility as an opportunity. If the price of a good company drops, it could be a chance to buy more at a discount as long as you still believe in the company's long-term prospects.
So it's like turning a negative into a positive.
Right. It's about shifting your perspective and seeing the potential in every situation.
Okay, so to kind of sum up, what we've learned from this deep dive into this article, there's definitely some uncertainty out there as we look towards 2025. But the message isn't to panic, it's to be prepared.
Exactly.
It's to build that emergency fund, diversify your investments, consider those defensive stocks, the companies that provide those essential goods and services, and most importantly, have that long-term mindset. Don't let the short-term ups and downs throw you off course.
Right. It's about staying focused on your goals and not getting distracted by the noise.
And this article, it gives us a great starting point. It gives us some specific stocks to consider, but it also raises a bigger question, what other sectors or investment approaches might offer that same kind of stability during uncertain times? What else is out there? And I think that's where, your own research comes in, taking these insights and really, doing your own due diligence to figure out what works best for your own situation.
Exactly. I think that's the key takeaway. Use this information as a springboard, but ultimately you have to make the decisions that are right for you.
And that's what it's all about, taking control of your financial future and feeling confident about your choices.
Absolutely.
All right, well, that's been a great deep dive. Thanks for walking us through it.
My pleasure.
And to all of you listening out there, stay informed, stay engaged, and stay ahead of the curve. We'll see you next time.
See you then.